Okay, let's now take a look at equipment replacement decisions. Recall that I did mention earlier in one of the other videos that in this chapter we are going to take into consideration as basic of information as we can in order to keep this simple. However, I can assure you that in the real world this could be a whole lot more convoluted. I'm pretty sure that in your textbook, in the back of it, there should be some other chapters that take the information like we're about to look at, but add some additional elements or components to it. For example, time value of money, regarding cash inflows and outflows, regarding operating expenses. What about tax implications over time and the time value of money regarding that as well. So again, this could be very complicated, but we're going to try to keep it as simple as possible. But be prepared. Out in the real world, you may see some more complicated calculations that have to be performed. So you're going to couple things that you've learned in your finance classes, plus your intermediate, plus this particular course in order to make those adjustments to the calculations. All right, so we have got a company that is interested in possibly purchasing a new and more efficient machine and replacing their old one. When they do this, they would also sell off their old equipment and recoup some cash flow for that particular piece of equipment. We could have different changes to that particular scenario, so just read through your homework questions and your ICPs if there's one on it regarding equipment purchases and replacement. We could also look at this in regards to optimizing a machine. What if we could make a huge capital improvement to a piece of equipment? Something that would cost us a lot of money to do, but make a piece of equipment more efficient. We could analyze that same type of scenario, okay? But we're just going to look at equipment replacement. All right, sometimes these are difficult to do due to the amount of information at hand that we can gather, and some of that information is relevant, but some of it is not relevant. So you guys have to be very careful when you perform the calculations for these. We know what a sunk cost is. So if it cannot be changed, then it is sunk. So when we evaluate the original piece of equipment that is still on hand and available, the fact that we've already paid for it is the fact that it's a sunk cost. So the historical cost is irrelevant. The accumulated depreciation, which we know is part of that historical cost number, is also therefore irrelevant. The remaining book value, historical cost minus accumulated depreciation to date, is also irrelevant. Even the amount that is going to be depreciated going further or removed from the books in a sale of that asset, even if a gain or loss is recognized. Okay, so the remaining book value comes into play when we sell the asset. Cash proceeds minus remaining book value equals gain or loss. It doesn't matter. It's still irrelevant because it is part of that original historical amount that was spent a long time ago. Okay, so they're all irrelevant. It is sunk cost. Now, the cash proceeds that we could collect on selling that piece of equipment, now that's relevant, but the rest of it is not. Any potential gain or loss on the transaction is a financial accounting phenomenon only. Ignore it. But the cash proceeds we're not going to ignore. We have a decision rule. Of course, it's still all about operating income. We want to go with the particular choice that generates the highest operating income. All right, so let's take a look at the scenario that's offered to us. We've got an old machine. It was originally purchased for $1 million. It had a useful life of 5 years. It has been used for 3, and they've made this really easy for us and left its remaining useful life at 2, which is equal to the new machine's useful life. Okay, so that simplifies this for us. The accumulated depreciation to date is $600,000. The remaining book value, of course, is $400,000. However, we do need to pay attention to the fact that we could sell that piece of equipment for $40,000 in cash. That will aid us in purchasing the new machine. So we're going to consider that $40,000 cash inflow. If we were to dispose of it in 2 years from now, it would still be 0. We wouldn't be able to get anything for it. And if we continue to use this machine, our annual operating costs are $800,000. The whole reason why we're looking is because if we were to replace it with this newer machine, look at the savings between the new machine's operating cost of $460,000 and the annual operating cost of $800,000. Okay, so we're talking $340,000 a year in savings. So would it benefit us to actually go about purchasing this new machine and selling off the old machine? The new machine's going to cost us, though, a whopping $600,000. Again, it's over 2 years useful life. So the entire $600,000 would be depreciated over the 2 years. All right, so should we or shouldn't we? This next page right here shows us everything. Relevant and irrelevant information. We have already said that relevant information is information that is going to change amongst the alternatives, and irrelevant information does not change amongst the alternatives, so we really don't even need to go through gathering the information and even putting it in our calculation. So we have revenues. The revenues are going to remain the same whether we use the old machine or the new machine. So these are really irrelevant. Notice that they net out to a 0 difference. The cash operating costs are different amongst the alternatives. We had $800,000 a year and $460,000 a year. So over the next 2 years, the old machine would cost us $1.6 million, and the new machine would cost us only $920,000 for a savings of $680,000 if you wanted to compare. The book value of the old machine, which was the $1 million minus accumulated depreciation to date of $600,000, is the remaining $400,000. But we've already discussed this. It's irrelevant. It has already been spent. It's a sunk cost. It doesn't matter in our decision. Notice that under this column 2, it is showing us that if we sold off that piece of equipment, we would be removing that remaining book value in that journal entry to get that piece of equipment off our book, right? And so that would be the $400,000. So these two, of course, are netting out. This is writing that remaining book value off as depreciation. This is removing that remaining book value in the sale of that asset. So they're negating each other. They're irrelevant. The cash proceeds, of course, we wouldn't have any cash proceeds coming in here in the keep column because we would be keeping it, not selling it. But over here, that $40,000, notice that it's showing up as a negative number, where these are costs and expenses and this is an inflow of cash. That's why this has brackets. This $40,000 is going to actually help us or reduce that outflow of buying the new machine for $600. Okay, so in essence, $600 is going out, but $40 is coming in to offset that. So in all reality, $560,000 in cash would be used to make this happen. All right, so based on this, we would have an operating income of $320,000 if we replace the machine with a new one, and only $200,000 in operating income if we keep our old machine and continue to have a lot of operating costs. So we should select to buy the new machine and sell off the old one. It's unfortunate that they've got negative brackets here, but we definitely would need to replace the machine. The better way to look at it is to eliminate all of those irrelevant things, right? We don't need to have the revenue showing up. We don't need to show the remaining book value of the old piece of equipment. We don't need that. So just plot it out like this. If we keep it, our operating expenses are going to be $1.6 million. If we replace it, we'll have a cash inflow of $40,000 from selling off the old machine, and that number will help us cover the new machine purchase price of $600,000, and we've got cash operating costs at a much cheaper annual rate, and we would still select to replace. So notice this one is breaking it down by relevant cost, $1.6 million versus $1.48 million. This is definitely cheaper than this one, and that is why we would select it. Do keep in mind that managers sometimes are making these decisions on their own without oversight from corporate management. Think of those decentralized operations. Corporate management only sends down so many decisions, and they expect those underlying managers to do their job, best benefiting the organization. Well, despite the quantitative nature of some aspects of decision making, not all managers will choose the best alternative for the firm. We will talk about this more in some of our future chapters, but keep in mind that these managers will be evaluated on their performance, their controllable margins, the things that they have a center of influence over. And sometimes, based on the information and how they will be evaluated, what looks good for the company is going to be ignored by a manager looking out more for themselves than for the company. So managers will consider how the company will judge his or her performance after the decision is implemented. And many managers consider it unethical to take actions that make their own performance look good when these actions are not in the best interest of the firm. These are the folks that we are glad we have around. These are the ones we need to keep an eye on. So when you guys are helping management with employee performance and evaluation and setting up metrics, think of the underlying calculations and the effects and also the decision authority that some of these managers have. So consider these things. We have the step 4 in the decision model, and it can dictate one decision, but in the real world, would the manager want to follow it or not? Again, look at how they're going to be evaluated. I know you guys can read these, making sure there's not something else in here I need to cover. You have several terms to look through. That's pretty much chapter 11. We will cover the next chapter.